the key to your financial future. Understanding your credit score. Alright, what is going on, guys? It's Moses here, and welcome back to the channel. Today we're diving into something that has a massive impact on your financial life, your credit score. Your credit score is like your financial GPA, opening or closing doors to major life opportunities, from buying a house to getting a good car loan, or even renting an apartment. We're demystifying your credit score, showing you how it works, and giving you the blueprint to build an excellent one, saving you thousands in the long run. My goal here is to break it all down, Graham Stephan style. No fluff, just the essential information you need to take control. We're going to cover what a credit score is, why it's the gatekeeper to so many financial products, the exact factors that make up your score, and most importantly, how you can improve yours. So if you're ready to unlock some serious financial advantages, make sure you stick around, maybe grab a coffee, and let's get into it. The what and why decoding your credit score. So let's kick things off with the absolute basics. What even a credit score? Simply put, a credit score is a three-digit number, usually ranging from about 300 to 850, that lenders use to estimate how likely you are to pay back borrowed money. Think of it as a snapshot of your creditworthiness at a specific point in time. The higher that number, the more financially trustworthy you appear to banks, credit card companies, and other lenders. It's like a reputation score for your finances. If you've consistently shown you can handle debt responsibly, your score will reflect that, and lenders will be much more eager to work with you, often on much better terms. This isn't just some arbitrary number. It's calculated based on your past financial behavior. Now, why do lenders care so much about this score? It all comes down to risk. When a bank lends you money, whether it's for a $500 credit card limit or a $500,000 mortgage, they're taking a risk. They want to be reasonably sure they're going to get their money back, plus interest. Your credit score gives them a standardized way to assess that risk. A high score suggests you're a low-risk borrower, meaning you're likely to make your payments on time. A low score, on the other hand, flags you as a higher risk, and lenders will either deny your application or charge you much higher interest rates to compensate for that increased risk. The Kingpin payment history, 35%. All right, now that we know what credit score is and it's so incredibly important, let's break down the factors that actually make up that score. And the heavyweight champion, the absolute kingpin of them all, accounting for a whopping 35% of your FICO score, which is one of the most commonly used scores, is your payment history. This is, without a doubt, the single most influential factor. If you only focus on one thing to build good credit, this should be it. Lenders want to see a consistent, reliable track record of you paying your bills on time, every single time. It's that simple, yet so critical. Think about it from the lender's perspective. If they're going to lend you money, the most basic assurance they need is that you'll actually pay them back as agreed. Your payment history is the primary evidence of your ability and willingness to do just that. It shows whether you've been responsible with past credit obligations, like credit cards, student loans, car loans, or mortgages. The balancing act amounts owed and credit utilization, 30%. Coming in as the second most important factor, accounting for a very significant 30% of your FICO score, is amounts owed, or what's more commonly talked about as your credit utilization ratio. This sounds a bit technical, but it's actually a pretty straightforward concept. It basically looks at how much of your available revolving credit you're using at any given time. Primarily, this refers to your credit cards. Lenders want to see that you're not maxing out your credit cards, as that can be a sign of financial distress or over-reliance on borrowed money. Let's break down credit utilization. Imagine you have one credit card with a $1,000 credit limit. If you have a balance of $300 on that card, your credit utilization for that card is 30%, $300 divided by $1,000. If you have multiple credit cards, lenders will look at the utilization on each card individually, as well as your overall utilization across all your cards. All right, moving on to the next piece of the credit score puzzle, we have the length of credit history, which typically accounts for about 15% of your FICO score. This factor, as the name suggests, looks at how long you've been using credit. Generally speaking, the longer your credit history, the better it is for your score, provided that history is positive, of course. Lenders like to see a long track record of responsible credit management, because it gives them more data points to assess your reliability over time. A short credit history isn't necessarily bad, especially if you're young, but it means lenders have less information to go on. This factor considers a few different things. It looks at the age of your oldest credit account, the age of your newest credit account, and the average age of all your accounts. So, if your oldest credit card is 10 years old, that's a great anchor for your credit history. Next up, we have a factor that accounts for about 10% of your FICO score, your credit mix. This refers to the variety of credit products you have in your name and are managing responsibly. Lenders generally like to see that you can handle different types of credit, not just one. Think of it like this. If you can successfully juggle apples, oranges, and bananas, you're probably a more skilled juggler than someone who can only handle apples. Similarly, managing different credit types can indicate a broader financial maturity and capability. What kind of mix are we talking about? Credit products generally fall into two main categories: revolving credit and installment loans. Revolving credit typically includes credit cards and lines of credit where you have a set credit limit. You can borrow up to that limit, pay it back, and borrow again. The amount you owe can fluctuate. All right, the final distinct factor that contributes to your credit score, also weighing in at about 10%, is new credit. This category looks at your recent activity in terms of opening new credit accounts and the number of inquiries on your credit report. Lenders can get a little wary if they see someone suddenly applying for a lot of credit in a short period. It can be a red flag that the person might be in financial trouble, overextending themselves, or about to take on a large amount of new debt that they might struggle to repay. So, what exactly does new credit encompass? It includes things like how many new accounts you've opened recently, how many hard inquiries are showing on your credit report. A hard inquiry happens when a lender checks your credit because you've applied for credit, how long it's been since you last opened a new account, and how long it's been since you last had a hard inquiry. Each time you apply for a new credit card, a loan, or sometimes even a new cell phone plan or utility service, it can result in a hard inquiry, which might temporarily ding your score by a few points. Now, a single hard inquiry here or there isn't usually a big deal, especially if you have a strong established credit history. Your score will typically recover fairly quickly. Okay, so we've dissected the credit score, we know why it matters, and we've gone through all the factors that make it up. Now, for the most important part, what actionable steps can you, Moses' amazing viewers, take right now to build, improve, or maintain an excellent credit score? Let's get into the practical blueprint. First and foremost, and I cannot stress this enough, is to pay all your bills on time. This is the absolute cornerstone, directly impacting that huge 35% for payment history. Set up automatic payments for at least the minimum due on all your credit cards and loans. Use calendar reminders. Do whatever it takes. Even one 30-day late payment can drop your score significantly. Make on-time payments non-negotiable in your financial life. Second, keep your credit card balances low. All right, guys, that is a deep dive into the world of credit scores. We've covered what they are, why they're so incredibly vital for your financial health, the nitty-gritty of what goes into them, and most importantly, a whole bunch of actionable strategies you can use to build and protect your score. Remember, your credit score isn't just a number. It's a reflection of your financial habits and a key that can unlock better opportunities and save you a substantial amount of money over your lifetime. It's about financial empowerment and giving you more control over your future. Your credit score is a powerful tool in your financial toolkit. By understanding these factors, payment history, amounts owed, length of credit history, credit mix, and new credit, and by taking consistent, positive action, you can build a strong score that opens up a world of financial opportunities. So, here's your challenge. If you haven't done so recently, check your credit score and your full credit report for free. You can use services like Credit Karma or the tools often provided by your own bank or credit card company for the score. And remember annualcreditreport.com for those detailed reports. See where you stand, identify areas for improvement, and start implementing these tips today.